The sound of paper, that is the loudest sound in the modern economy. Not the shouting of traders on a floor, not the ring of a bell, but the dry, rasping friction of a single envelope being sliced open on a kitchen island. It's a Tuesday. The coffee is warm. The house is quiet. You just grab the mail. Refugees of the 2008 crash learned to fear the phone call. They learned to fear the knock on the door. But the crisis of 2025 doesn't knock. It sends a letter. Inside, the language is polite, corporate, sanitized, but the message is violent in its implications. Asterisk. We regret to inform you that upon renewal, we will no longer be extending coverage to this property. Asterisk. You read it twice. You checked the header. It's not a mistake. It's a retraction of protection. You might think this is an annoyance. You might think you'll just call another carrier. You'll hop on Google, find a competitor, maybe pay $50 more a month. That is the illusion, because when you make those calls, when you dial Geico or State Farm or Allstate, the line on the other end is dead silent. They aren't writing new policies in your zip code. Your zip code has been flagged. You are now standing in a coverage desert, and it's at that precise moment, holding that piece of paper, that you realize you don't actually own a home. You own a liability. This isn't a hypothetical nightmare. This is the operational reality for 1.4 million Americans right now. Let's look at the data. The real data, not the headline inflation numbers they feed you to keep you calm. American National, a stalwart, a name that implies stability. In 2024, they didn't just adjust their rates. They didn't just pull out of high-risk zones like the Florida coast or the California wildfire belts. They initiated a total exit strategy. Homeowners insurance, 50 states, gone. They looked at the actuarial tables. They looked at the replacement costs. They looked at the climate models, and they said, asterisk, no. Asterisk, they realized that the math of the American dream no longer sums to a positive number. When an insurer like American National leaves the entire board, they are telling you something terrifying about the game itself. They are telling you that the game is rigged against the house, literally, and they aren't alone. 1.4 million cancellations. Think about that number. That's not a statistic. That is the population of San Diego. Every single man, woman, and child suddenly finding out their financial foundation has been liquidated. But here is where the horror truly sets in. It's the mechanics. The boring, bureaucratic mechanics of what happens next. Most people barely understand their mortgage contract. It's a stack of paper you signed 15 years ago while your hand cramped. But there is a clause in there. A paragraph usually buried on page 34. It states, unequivocally, that the borrower must maintain hazard insurance to protect the lender's collateral. When you lose your insurance, you are in technical default. The bank doesn't care about your memories in that house. They care about their asset. And when you call them, panicked, explaining that no one will insure you, they won't offer sympathy. They will initiate force-placed insurance. If you haven't heard that term, pray you never experience it. Force-placed insurance is a policy the bank takes out times for times you. It protects times them, asterisk. It does not cover your furniture. It does not cover your liability if someone slips on your driveway. And the cost? It is often 4 to 10 times higher than your standard premium. If you were paying $2,000 a year, suddenly the bank adds a surcharge of $20,000 to your escrow. Your monthly payment doubles overnight. And just like that, the liquidity is gone. You had savings, you had a budget, you had a life. Now you are bleeding out month after month, funneling every spare dollar into a policy that doesn't even protect you just to keep the bank from foreclosing. This is the liquidity illusion. On paper, you are solvent. On paper, the economy is growing. But in your bank account, a sinkhole has opened up. And while you are staring at that letter on your kitchen island, wondering how you are going to survive this. You need to look out the window, look past your lawn, look toward the city skyline, because the rot isn't just in the suburbs. The suburbs are the nervous system, but the skyscrapers, they are the bones. And the bones are breaking. If you think the residential insurance crisis is a disaster, turn your eyes to commercial real estate. The office tower, the strip mall, the distribution center. These buildings don't have 30-year fixed mortgages. They have what we call balloon payments. Every 5, 7, or 10 years, the owner has to pay off the loan or refinance it. They have to go back to the bank and ask for a new deal. And waiting for them, standing there like an executioner, is the year 2026. We call it the maturity wall. Current data indicates that over $1.5 trillion in commercial real estate debt is coming due. 1.5 trillion. That number is abstract. Let me make it concrete. That is the GDP of Spain. That is more than the value of the entire crypto market during the winter. And it's all hitting the refinancing window at the exact same time. But here is the problem. These loans were written 5 or 7 years ago. Back then, money was free. Interest rates were near zero. Occupancy rates were high. The valuation of those towers was based on a world that no longer exists. Now, the owner walks into the bank. They say, I need to refinance my $100 million loan. The banker looks at the building. It's half empty because remote work killed the office culture. The insurance costs have tripled because of the same crisis hitting your home. And the interest rate? It's not 3% anymore. It's 7%. It's 8%. The banker runs the numbers. I can't lend you $100 million, the banker says. This building is only worth $60 million now. Who pays the difference? The owner doesn't have $40 million in cash lying around. So they hand over the keys. This is already happening. Look at Los Angeles. Look at San Francisco. Major towers, trophies of the skyline, selling for 50% off. But 2026 isn't a trickle, it's a dam breaking. And when a $1.5 trillion wave hits a banking system that is already fragile, the water doesn't stay in the commercial sector. It floods everything. Regional banks hold the vast majority of these commercial loans. The same regional banks that hold your savings, the same regional banks that finance small businesses. When the collateral collapses, when the skyscrapers turn into zombie assets, the banks contract. They stop lending. To everyone, the credit card limits get slashed. The car loans get denied. The business lines of credit dry up. That liquidity you thought you had, that ability to swipe your card and trust it would work, it was an illusion maintained by asset values that were fakes. We are walking on a frozen lake. The ice is beautiful. It looks thick. You can see your reflection in it. But beneath your feet, the cracks are spreading. First, it's the insurance letter on your counter. Then, it's the for lease sign on the office building. Then, it's the closed sign on the bank branch. Most people are waiting for a crash. They are waiting for a single day where the stock market drops 20%. They are watching the wrong screen. The crash isn't coming. It's already here. It's just moving slowly, hiding in the fine print of insurance renewals and refinance applications. It's in the silence of that kitchen. So, put the letter down. Look at your house. Really look at it. Is it a castle? Or is it a cage? Because for millions of Americans, the lock just clicked shut. If you think a frozen market always thaws, you haven't looked at the ghost of Tokyo. We need to leave your kitchen now. We need to leave the American suburbs, leave the illusion of the soft landing, and travel back in time. Set the clock to December 29th, 1989. You are standing in the center of Tokyo. The air smells of ozone and expensive cologne. The neon lights of Ginza are so bright they wash out the stars. The Nikkei index is screaming at 38,915. It is the peak of human financial hubris, the apex of the land myth. At the center of the city sits the Imperial Palace. It's a quiet, green void in the middle of the concrete insanity. Just under 1.5 square miles of trees, moats, and stone walls. Now, do the math with me. In 1989, the land underneath that one single palace was valued higher than the entire state of California. Let that sink into your marrow. Take the Hollywood Hills, take the vineyards of Napa, take the ports of Long Beach, the mansions of Malibu, the redwood forests, the Golden Gate Bridge, and the entire coastline from San Diego to Oregon. Combine them, and they were worth less than a park in Tokyo. This wasn't economics. It was mass psychosis, disguised as a bull market. The data from that year tells a story that should terrify every American homeowner looking at their Zestimate right now. Japan is roughly the size of California. Yet, in 1989, the theoretical value of Japanese real estate was 4 times greater than the entire United States of America. 4 times. They said it was different there. They said land in Japan was scarce. They said prices could only go up because God isn't making any more land. Sound familiar? Do you hear the echo of your own dinner table conversations? Real estate always goes up. Buy now or be priced out forever. It's a new paradigm. The Japanese believed it too. They bet their lives on it. They took out 100-year mortgages, not 30, 100. They signed contracts that would bind their grandchildren to a small concrete box in Shinjuku, convinced they were passing down a fortune. But they weren't passing down wealth. They were passing down a curse. Because on the first trading day of 1990, the music stopped. It didn't explode like a bomb. Markets rarely do. Real estate is heavy. It moves slow. It dies slow. It started with a freeze. Just like the one we are seeing in Florida and Texas right now. Buyers stepped back. Sellers refused to lower prices because their pride and their bank loans wouldn't let them. Volume dried up. Then came the lost decades. Not a lost year. Not a recession. Decades. Plural. If you bought a condo in Tokyo in 1990, you didn't just lose money. You were annihilated. By 2005, residential land prices in the 6 major Japanese cities hadn't just dipped. They had collapsed by 60%. In some commercial sectors, 80%. 80%? Imagine buying a home for $1 million, and 15 years later, the bank tells you it's worth $200,000, but you still owe the million. That isn't a financial loss. That is a prison sentence. You work every day. You commute on the crowded trains. You eat cheap bento boxes. You save every yen, and every single yen you earn goes into a black hole of negative equity that you will never, ever escape. This is what a deflationary collapse looks like. It's not fire and brimstone. It's silence. It's the silence of zombie banks, financial institutions that are technically dead, insolvent, holding trillions in bad loans, but kept on life support by the government just to keep the ATMs running. Japan turned its entire economy into a nursing home for dying bad debt. They treated the liquidity crisis by printing money, by lowering rates to zero, by pretending that if they just waited long enough, the values would come back. They didn't. And here is the horror story. Look at the chart of the NASDAQ today. Look at the Case-Shiller Home Price Index. Now, look at Tokyo. We are repeating every single step of the Japanese suicide ritual. We have the asset bubble. We have the "it's different this time" narrative. We have the central bank that thinks it can control gravity. But the physics of leverage are universal. When the leverage unwinds, the value vanishes. It doesn't go to someone else. It simply ceases to exist. That theoretical wealth, that equity you think you have in your home, it evaporates. The Japanese experience proves that real estate is not a savings account. It is a levered bet on the future productivity of a nation. And when a nation's demographics collapse, when its debt suffocates its growth, that bet goes to zero. You might be thinking, but we aren't Japan. We have the world reserve currency. We have the military. Japan had the manufacturing might of the entire world. They bought Rockefeller Center. They bought Pebble Beach. They were unstoppable. Until they weren't. The collapse of the Japanese bubble wasn't just about money. It broke the soul of the country. It created a generation of hikikomori young men who locked themselves in their rooms for decades, refusing to participate in a game they knew was rigged. It created a society that stopped having children, stopped dreaming, stopped living. It became a necrotic limb on the body of the global economy. Which brings us back to you. You are standing in the shadow of this history, whether you know it or not. The Federal Reserve knows it. The shadow bankers know it. They have studied the Tokyo crash. They know exactly what happens when the land myth dies. That's why they are terrified. Because the American bubble is bigger than Japan's ever was. The derivatives market attached to our real estate makes the 1,989 bubble look like a lemonade stand. And now, the cracks are forming. Commercial real estate in San Francisco is selling at discounts that mirror 1990s Tokyo, 50% off, 60% off. The contagion is moving from the office towers to the apartment complexes, and finally, it will come for your suburban street. History doesn't repeat, but it rhymes. And right now, the poem is screaming. The yen shattered. The glitz of 1980s Tokyo rusted into the stagnation of the 2000s. And what was left behind? Shards, sharp, jagged pieces of a broken promise. That is what you are holding when you look at your bank account today. You are holding the remnants of a currency that is being sacrificed to keep the bubble inflated for just one more day. We are about to show you the physical cost of that sacrifice. It's not just a number on a screen. Look at your hands. Look at your hands. The shards of the Japanese yen, the shards of your purchasing power, they are small. They are sharp. They are personal. But if you look up, the danger isn't small. It is monolithic. It is blocking out the sun. You are standing in the shadow of the American skyscraper, the steel and glass cathedral of the 20th century economy. For decades, we were told these structures were the bedrock, safe as houses, they said. But they didn't mean your house. They meant times their times office blocks. They meant the collateral that underpins every pension fund, every regional bank, and every insurance policy in the Western world. But walk into one of them today. San Francisco, Chicago, New York. It's Tuesday morning, 9 a.m. This used to be the power hour. The lobby should be a mosh pit of suits, coffee cups, and frantic energy. The elevators should be packed tight enough to smell the fear and the cologne. Now? Silence. The security guard is scrolling on his phone. He doesn't even look up. The elevator bank is empty. You get in. You press 34. The doors slide shut with a heavy, expensive times whoosh asterisk. You step out onto the floor. Rows of empty cubicles. Dust motes dancing in the unfiltered sunlight. The ergonomic chairs are still there, pushed in, waiting for workers who are never coming back. The plants are dead. The coffee machine is cold. This isn't a workspace anymore. It's a mausoleum. New data from late 2024 and heading into 2025 confirms what your eyes are seeing. We are looking at an $800 billion valuation wipeout. Let that number sink in. $800 billion. That's not a correction. That's not a soft landing. That is the GDP of Switzerland. Evaporated. Gone. Poof. It didn't move to another asset class. It didn't go into Bitcoin or gold. It simply ceased to exist. Because value is a belief system, and the belief that a generic glass box in downtown Chicago is worth $500 a square foot, that belief is dead. So, who takes the loss? In a free market, the owner goes broke. The bank seizes the building. The building is sold for pennies on the dollar. The market clears. The pain is sharp, but it's fast. But we do not live in a free market. We live in a managed hallucination. If the banks admitted the truth, if they marked these assets to their real market price of times 0 times, the entire regional banking system of the United States would dissolve overnight. So they don't do that. Instead, they are playing a game. A sick, dangerous game known in the industry as extend and pretend. Here is how it works. A developer owes the bank $100 million for a building that is now worth $40 million. The loan is due today. The developer can't pay. The banker looks at the developer. The developer looks at the banker. If the banker calls the loan, he has to book a $60 million loss. His bonus is gone. His bank's capital ratios fall below the legal limit. The FDIC comes in on Friday afternoon and shuts him down. So the banker smiles. He picks up a pen. He says, "Tell you what, let's pretend you're not bankrupt. I'll modify the loan. I'll give you 2 more years. I'll lower the interest rate. I won't make you pay any principal." They sign the paper. The loan stays on the books as performing. The bank remains solvent. The developer remains a tycoon. And the rot spreads deeper into the bone. The Federal Reserve of St. Louis just released the numbers. They aren't hiding it anymore, if you know where to look. In the second quarter of 2025 alone, U.S. banks reported $27.7 billion in commercial real estate loan modifications. That is a 66% surge. Think about that trajectory. A 66% increase in banks frantically rewriting the rules to avoid facing reality. They are treating a necrotic limb with a band-aid. They call it modification. I call it fraud. They are taking a dead asset and painting blush on its cheeks to make it look alive for 1 more quarter. But here is where the story gets truly terrifying. Because the big banks, JP Morgan, Bank of America, they saw this coming. They aren't stupid. They started offloading this toxic waste years ago. So where did it go? Did it disappear? No. Matter cannot be created or destroyed. It just changes form. The debt moved into the shadows. It moved into private credit. This is the necrotic limb of the financial system that nobody talks about on CNBC. Private credit. It sounds elite, doesn't it? It sounds exclusive. It is actually the unregulated, opaque, wild west of the debt market. These are non-bank lenders. They don't have to report to the FDIC. They don't have to mark their assets to market every day. They operate in the dark, and right now, they are sitting on a ticking time bomb. As we move through 2025, over $1 trillion in these private credit loans are hitting maturity. They call it the maturity wall. I call it the cliff edge. These loans were written 3, 4, 5 years ago, back when interest rates were near 0, back when we thought office work was forever. Now, those borrowers have to refinance, but interest rates are higher, and their buildings are empty. Delinquency rates for office properties in this shadow sector are already climbing past 10%. That is the tipping point. When a bank fails, you see lines around the block, you see news crews, the government steps in. When a private credit fund fails, it's like a submarine imploding at crushed depth. It happens instantly. There is no warning. There is just a sudden, violent void where money used to be. And you might be thinking, I don't own a skyscraper. I'm not a private equity billionaire. Why should I care if Blackstone or Brookfield takes a haircut? Because you aren't the observer. You are the collateral. Who do you think funds private credit? Pension funds, asterisk, Your Times Pension Fund. University endowments, asterisk, Your Times Children's College Fund. Insurance companies, asterisk, Your Times annuity. They chased the yield because government bonds paid nothing. They poured your retirement future into these shadow banks, thinking they were getting a safe 8% return from diversified real estate assets. They weren't buying assets, they were buying the debt of ghost towns. They were buying the necrotic tissue of a dying economy. Now, the gangrene is setting in. The scent is faint right now. You have to know what you're smelling. It smells like paper friction in a St. Louis Fed report. It smells like the stale air in an empty 40th floor boardroom in Manhattan. But soon, you won't need a sensitive nose. Because necessity is about to force a frantic amputation. The banks can extend and pretend for a quarter, maybe two, but they cannot fight the math forever. The $1 trillion maturity wall is not a suggestion, it is a mathematical certainty. The cash is not there, the tenants are not there. The value is not there. And when the lenders stop pretending, when the modifications stop, the write-downs begin. Not 5%, not 10%, zero. We are talking about the vaporization of equity on a scale that makes 2008 look like a warm-up act. In 2008, the houses still had people in them. The families wanted to stay. The asset had utility. These office towers, they are obsolete technology. They are the buggy whips of the digital age, built of steel and glass, leveraged 10021. The limb is dead. The doctors, the Fed, the Treasury, the bank CEOs, they are standing around the patient, arguing one wants to apply more leeches. One wants to print more blood. But nobody wants to pick up the saw because they know the truth. The necrosis has traveled too far. It has touched the vital organs. It is in the private credit markets. It is in the pension funds. It is in the regional banks. Amputation won't save the patient. Amputation times kills times the patient. So they will wait. They will extend. They will pretend. They will hold the dead hand and tell you it's still warm. Until the moment the body goes into septic shock. And that moment isn't years away. With $27 billion in panic modifications happening right now, with $1 trillion in shadow debt hitting the wall this year, the shock is already in the bloodstream. You just haven't felt the fever spike yet. But put a hand to your forehead. It's getting warm, isn't it? But even if the banks survive, even if the fever breaks and the patient stabilizes, the physics of homeownership have broken, and they are not coming back together. You see, for the last 50 years, the American dream relied on a silent partner, a boring, invisible partner, insurance. It was the safety net that allowed the bank to lend you $500,000 for a pile of wood and drywall. It was the guarantee that said, if the wind blows this down, the money is still safe. But that guarantee is gone. Asterisk, long pause, asterisk. It didn't leave with a bang. It left with a letter in the mail. Right now, in California, in Florida, in Texas, the standard insurance market is evaporating. State Farm, Allstate, Farmers, they aren't just raising rates. They are leaving the building, and stepping into their place is something called the E&S market, excess and surplus. The name sounds technical, harmless. It is not. By mid-2025, premiums in this market of last resort surged 13% to over $46 billion. Do you understand what E&S insurance is? It is the vulture encircling the carcass of the property market. It is unregulated pricing. It is stripped-down coverage. It is a contract that says, we will take your money, but if your roof flies off, we promise nothing. And people are fighting for it. They are begging for it, because without it, they are in technical default on their mortgage. But here is where the math turns into a weapon. Look at the deductibles. In 2025, the adoption of percentage-based deductibles rose by 63%. Average deductibles spiked nearly 25% in a single year. Think about what that means. It means your deductible isn't $1,000 anymore. It's 2% of your home's value. It's 5% of your home's value. If you have a $500,000 home and a storm tears through your living room, you are writing a check for $25,000. Asterisk, before times, the insurance company pays a single dime. You aren't insured. You are self-insured. You just haven't realized it yet. You are paying a premium to a company that has mathematically engineered a way to never pay you back. And if you think the government is coming to save you, If you think FEMA is the backstop, look at the ledger. As of February 2025, the National Flood Insurance Program is drowning in $22.5 billion of debt. They had to borrow another $2 billion just to keep the lights on after the hurricanes last fall. The lifeboat is full of holes. The captain is bankrupt, and the water is rising. This creates the death spiral, and it works like this. Your insurance premium doubles to $8,000 a year. That's an extra $700 a month. That's your grocery budget gone. So, you try to sell the house, but the buyer looks at the same math. They see the insurance cost, they see the risk, and their lender sees it too. The bank tells the buyer, "We can't write a mortgage on this. The insurance doesn't cover the risk." Uninsurable means unmortgageable, and unmortgageable means the value is zero. It doesn't matter what your Zestimate says. It doesn't matter what your neighbor sold for 2 years ago. If a bank cannot secure the asset against nature, the asset ceases to exist in the financial system. It becomes a cash-only liability, a heavy, rotting box that you cannot sell, you cannot insure, and you cannot afford to keep. Somewhere in Florida right now, there is a for sale sign swinging in the breeze. The house looks perfect. The lawn is manicured. The paint is fresh, but nobody is calling. The phone isn't ringing because the price is too high. The phone isn't ringing because the house is already dead. It's just waiting for the foreclosure notice to make it official. Now, take that for sale sign and multiply it by 10 million. 10 million signs. Do you see them? Picture them lining the streets of your neighborhood, like tombstones in a graveyard that stretches from the Atlantic to the Pacific. 10 million pleas for a bailout that isn't coming. And as you drive past them, as you navigate this silent necropolis of the American dream, you realize something terrifying. You don't want to stop, you don't want to buy, you don't even want to look. Because in a falling empire, the man who owns the land is the man who pays the tax. He is the man who pays the insurance. He is the man who takes the loss. In a falling empire, the one who owns nothing loses nothing. Welcome to the age of the tactical renter. I know what you were told. I know the script that was burned into your brain since you were a child sitting on your grandfather's carpet. Rent is throwing money away. You're paying your landlord's mortgage. Real estate only goes up. That script was written for a world that died in 2024. Burn it. If you are still trying to buy a home right now, if you are scraping together a down payment, begging a loan officer, signing your life away on a 30-year deed, you aren't an investor. You are a volunteer victim. Let's look at the math. The real math, not the brochure math. In 2021, the gap between renting and buying was negative. It favored the buyer. It made sense to own. It was a rational financial decision. But look at the charts for 2025. Look at the spread. We have witnessed the single greatest inversion in the history of the American housing market. As of right now, buying a home in the top 100 cities in this country costs 57% more than renting that exact same home. 57%. Let that sink in. You are paying a 57% premium for times what asterisk? For the pride of ownership? Pride doesn't pay for groceries. Pride doesn't keep the lights on when the grid price spikes. Pride is a luxury item, and you can no longer afford it. Let's break it down to the monthly bleed. The raw capital leaving your bank account. The data shows that the average American who chooses to rent instead of buy in 2025 is saving over $900 a month. $908 to be precise. In cities like Austin, that number screams even higher. But let's stick to the average. $900, that is not just a savings, that is a lifeline. In the old world, that money went into equity. It was forced savings. You put it into the walls, and the walls held it for you. But today, with home prices correcting, with the market suffocating under interest rates that refuse to die, that money isn't going into equity. It's going into the incinerator. When you buy a house today, you are locking that $900 into an asset that is depreciating. You are throwing it into interest payments that barely touch the principal. You are handing it to an insurance company that will cancel you the moment the wind blows too hard. But if you rent, that $900 sits in your pocket. It is liquid. Liquidity. Say it with me. Liquidity. It is the most boring word in finance. And right now, it is the only thing standing between you and starvation. Think about the homeowner tonight. He is lying in bed. He hears the wind rattling the gutters. He's wondering if the roof will hold. He's thinking about the property tax assessment that just arrived up 20% to cover the city's pension deficit. He is thinking about the boiler making that clanking sound in the basement. He is asset rich. Maybe. On paper. But he is cash poor. He is trapped. He cannot move to a new city for a better job because he can't sell the house without taking a $50,000 loss. He cannot buy food when the inflation spike hits because his liquidity is frozen in drywall and landscaping. He is a prisoner of his own success. Now look at the tactical renter. You hear the wind? It's just weather. If the roof blows off, you leave, you move. You are a struggle nomad in a static world. You have $900 extra every single month. That is dry powder. That is ammunition. While the homeowner is drowning in maintenance costs and insurance premiums, you are building a war chest. When the market finally snaps, when the foreclosure signs we talked about multiply from 10 million to 20 million, cash will be king. Not credit, not equity, cash. The man with the cash determines the price. When the homeowner is desperate to sell, begging for someone to take the keys so he can just walk away, you will be the one standing there. But not yet. Right now, the strategy is patience. The struggle defines you, but your mobility saves you. You are essentially shorting the American housing market by refusing to participate in it. You are betting against the stability of the system. And looking at the data, looking at that 57% gap, that is the safest bet on the table. But there is a psychological toll here. I won't lie to you. It's hard to sit in a rental apartment with white walls you aren't allowed to paint. It's hard to feel like a guest in your own life. It feels temporary. Good. You times want times to be temporary. Permanent is dangerous when the foundation is cracking. Anchors are great for stability in calm waters. But when the ship is sinking, an anchor is just a weight that drags you to the bottom faster. Cut the chain. Let the homeowners sink with their stainless steel appliances and their granite countertops. Let them cling to the debris of the 20th century. You are light. You are fast. You are alive. Renting is no longer a failure. It is a bunker. It is a strategic retreat from a market that has become a slaughterhouse. So take that check you were going to write for a down payment. Keep it. Take that $900 a month. Stack it. Watch the savings account grow. Feel the vibration of that number increasing on your phone screen. That is the heartbeat of your survival. But this brings us to the next terrified realization. You have the cash. You have the liquidity. You have dodged the necrotic limb of the housing market. You are holding your wealth in your hands, ready to strike, ready to survive. But there is one problem left. A problem so large, it makes the housing crash look like a minor inconvenience. You are holding cash in a bank. You are trusting a digital ledger to tell you that your survival fund is safe. But take a look at the news. Take a look at the panicked meetings in Washington. The banks aren't looking at your deposits as liabilities anymore. They are looking at them as bail-ins. You secured your freedom from the land. But did you secure your freedom from the vault? Because that vault door is closing, and the silence inside is getting deafening. Most people will simply scroll past this warning, content with the official narrative, but you are still listening. You understand the math. The algorithm tries to bury this kind of data, so if you want to find your way back to the truth, you need to subscribe to the channel right now. Don't let the noise drown out the signal.